Hello, everyone. Welcome to Beyond the Books with Dorota O'Malley and my business partner, Jordan, the accountant podcast that proves finance doesn't have to be boring. We'll be talking about tax tips, money mistakes, balance sheet drama, and the occasional coffee fueled rant. If you work with numbers or just want to understand them, you're in the right place. Let's make accounting a little less dry and a lot more fun. Good opening, isn't it, Jordan?
Yep.
So, today's subject, what are we talking about today? We will be covering what is the difference between the sole trader and the limited company. A lot of the time, maybe people don't understand why they should go limited, and we're here to answer these questions today. So, Jordan, did you want to get started maybe?
Yeah, absolutely. So if we start on the difference between a sole trader and a limited company, obviously
Mhm.
the big difference between the two is that in a sole trade, the liability falls on you personally. If the business go under, you have to pay any debts back, If they need to be paid, they can start taking it out of your personal bank account. Whereas with a limited company, they are a separate entity in terms of liability. And what that basically means is the business isn't doing so well and you end up going under. When they try claiming back all the money for your creditors, the people you owe money to, all they can do is take business assets and access business bank accounts. They can't come after you personally.
Mhm.
There are rare situations where they could come after a director. That is sort of in the case where there's a criminal aspect between what you're doing, and I'd hope none of you are doing that sort of thing.
But that's further down the line, isn't it? If we are talking to a person that maybe will is asking why should I go limited, shall we just maybe explain what is a sole traded business and what sort of steps do you need to take to maybe register as a sole trader, and then after that we'll discuss what a limited company is.
Yeah, absolutely. I mean, so let's say you're starting out as a sole trader. Let's say you've got like a little market stall somewhere and you're making, I don't know, 30, 40, 50,000 pounds in turnover a year. Not enough to warrant going, incorporated, but just enough that you're going to start need doing a tax return. The first thing you need to do really is register for self-employment through HMRC. Get yourself a UTR, let them know that you're trading, all of that stuff. Then the next thing you want to move on to is making sure you've at least set up a spreadsheet keeping track of your income and expenses. Because otherwise, when you come to the end of the year and you either get an accountant in or try to do it yourself, you're going to be spending weeks and weeks trying to tidy up all your receipts, gather it all together, and be like, oh, what have I spent where? So if you get it all tracked on a spreadsheet, it's going to make your life 20 times easier. As a sole trader, you're requirements for reporting are a lot easier than what a company has to do. It's essentially just your income and expenses. You're not really having to worry about a balance sheet unless that's something you want to keep track of. You're not doing trade creditors. It's all sort of done through a cash system. So what goes in, what goes out. Um,
Yes, if it's a small sole trader business, I would say that the first step obviously is to notify HMRC that you're now going self-employed, embarking onto this wonderful self-employment world. And the UTI is unique tax reference number, which you need to always keep safe and use it for any reporting in future. That's what it's needed for. So it's a unique number for the HMRC to know who you are. And obviously, shall we maybe embark on to explaining what the business bank account is for and why it's so important to have it?
yeah, I mean, as a sole trade, what we see a lot of the time is people set up another personal bank account.
Mhm.
Because when you're a sole trader, you're not legally different to the business you're running. You can use sort of personal bank accounts. But let's say you were using your regular one that you're paying for your food shopping, your bills, all of that.
Mm.
Things start to get very confusing in what's a business expense and what's your personal expense. I've dealt with clients in the past where I've been going through bags of McDonald's receipts, all sorts of stuff, a Tesco receipt that's got milk, whatever else on it. And you end up putting 70% to drawings or what you're taking personally. Only about 30% of it is your business expenditure. Whereas if you're either opening what's known as an actual business bank account,
Mm.
or just a new personal bank account that you're using purely for the company, we can very clearly distinguish what is business expenditure, what you're taking from the business as personal income, and then that makes doing your profits at the end of the year a lot easier.
Yeah, you just, from the accountant's point of view, obviously, it just saves you a lot of time going through and fishing out and bothering the client with the questions of like, is this personal, is this business, and just deciphering between the two. And yeah, it's just much more easier to just open the business bank account and just even for yourself to see how much money is in the bank and etc. for cash flow reasons, right?
Yeah, it's a very easy way to see, if it's just the business income and outgoings, it's
Mm-hmm.
very easy to see a snapshot of where you are today. You can open the bank, be like, oh, I've got 5 grand there. That means I must be doing really well. I definitely use a bit of that for stock. You're not looking at it and being like, oh, I've got 5 grand in there, but that's also got to go on my mortgage
Mm-hmm.
or my rent, or I got to pay my lecky bill with that, and then I've still got to buy 2 grand's worth of stock. Oh, and I've got to feed the kids, and I've got to buy the Christmas presents. Having that all mixed into one balance isn't going to help you in any way, shape, or form.
Yes, exactly. And you did mention keeping spreadsheets, which obviously is a good way of keeping track at the beginning, but
Hmm.
obviously with the,
Realistically, you want to go
mm,
to a software that's going to make your life a lot easier.
exactly, especially
Um,
what's coming, the MTD ITSA,
mhm.
the quarterly reporting that's coming in, you are going to want to go into a software, which we predominantly work with Zero software, but just shop around and see what's out there, I would say.
Yeah, because of what it's from April next year, 2026, that if
Hmm.
you're
Yeah.
over £50,000, I think is
Over
the
fifty
requirement,
thousand pounds, yes, you
you're
then.
you're going to have to start reporting your earnings and your profits on a quarterly basis, even for a sole trader. And trying to do that from a spreadsheet is going to be an absolute nightmare.
Yeah.
As we know, a lot of the accounting softwares are going to be bringing in a way of reporting this, which will make your lives 20 times easier if you're already on it, rather than having to rush transfer over in April next year. And obviously that reporting requirement is going to be coming down in 2027 and 2028. It's going down 30 grand, and then is it 10 or 20?
Yes. So it's going in 2027, it's going down to £30,000, and
Hmm.
then HMRC will just make it very little for the next year. So it's good to consider something now and shop for the software, I would say.
Hmm.
Um,
Yeah,
I,
because by
yes,
2030, I imagine everyone's going to be on it, whether they make £1 or £100,000. So
yeah,
it's something we're
exactly.
not going to be able to avoid.
Yeah, that's what the HMRC wants to do. They want to move everyone to an accounting software. So it's all of this sort of keeping spreadsheets and doing things manually is not going to be beneficial anymore. I would say the software is really important because HMRC is actually not providing any tools for these people to submit these quarterly returns. So it's going to have to be something that you look into yourself.
Hmm. Yeah, which is quite surprising because I mean, when they started doing Making Tax Digital, they initially had a sort of format on their site that you could use for that. However, now that they're doing this, they're just leaving it to software companies,
Yeah.
which is going to make it a big barrier entry for a lot of small trading people that have never really done things that way.
Hmm.
So I think there's going to be a bit of a panic come next April, um,
Yes, you
on
know
the
it.
market. But these things happen, and I think once if you really crack down and work hard and get these things in place, that stress isn't going to be there. So,
Yes, and we are here to help with that, and we'll cover the MTD. It's in the coming months as well. We'll be talking
mhm.
about what the HMRC is expecting from you, why you have to submit 5 tax returns in a year, and are you going to also having to pay 5 times in a year, which is very unlikely, but you never know with the HMRC. We'll be covering all of that in our future podcasts. But yes, if you're at the in the place where you're thinking, okay, I want to go self-employed, I don't know whether I should go sole trader or limited. What are the differences? So as we spoke about, the sole trading is quite easy. You are the business. You're registering with the HMRC. The only difference is you need to have a separate bank account and sort of make sure that you separate your personal life from business to make it easier for yourself and for your accountant going forward. But now we have the limited. A lot of people don't know why maybe they should go limited. And is it really just from the profit point of view that we should be looking at the limited company?
So I think probably the big way that you're going to decide whether you need to go limited or stay as sole trade is, let's say your sole trade is starting to make you 40, 50, 60,000 pounds profit a year, you
Mm.
know, because your entire profit on a sole trade is charged to you as if it's what you're earning. You once you get up to that amount, you're starting to look at being in the additional rate for tax. So anything over your 52,000, I believe it is being charged at 40% rather than just the 20. So whereas if we then start turning the business into a company, we can control what those profits are, because profits inside a company are charged at a corporation tax rate, which
Yeah.
starts at 19% for small profits and then sort of gradually builds up depending on how much you're making up to a value of quarter of a million,
Hmm.
at which point you're paying 25%.
Yes.
However, the big difference there is when you're then having to pay personal tax on what's coming out of your business, usually you're charging dividends. You can obviously do what's known as a director's salary, so you're taking about £12,500 out of the business without any tax implications, which is always great. We like to be
Hmm.
as tax free as possible. And dividends themselves, when you start charging those, they're only done at 8.75% to start with. So
Hmm.
they're always taxed at a substantially reduced rate compared to what PAYE or regular employment is.
Hmm.
And so if your business is starting to make a lot of money as a profit, and you want to control how that tax implication is impacting you, a limited company is a really good way to do that.
Yes, definitely. I would say from the control point of view, a limited company is really good. You can obviously the it's you get taxed twice. So the corporation tax gets taxed for the profits that you make in a company, and then whatever you take out of the business that gets put on your tax return in, like Jordan said, in form of salary and dividends that get taxed separately. Um, but let's talk about the steps maybe of setting up a limited company. What is required and what is different from sole trader to limited company? What you need to do?
So one of the big things you have to do first as a limited company is register it on Company's House. So you go to Company's House and go through the process of registering a business. And one of the big parts of that is picking a name and making sure that name isn't taken by anyone else.
Yeah,
Luckily,
nobody thinks about that, do they?
no, no, no. They get to that point and they're like, "What do you mean I've got to pick a name?" Then they just type in what they're already calling the business, and it turns out there's 25 already there with various variations of 01, sort of like you're creating a new password.
Yeah.
So trying to find a unique company name, especially in this day and age, could be a bit difficult.
Hmm.
Luckily, HMRC has a really useful checker that you can use as you're sort of trying to figure this out.
Hmm.
Once you've got that company name and it's registered on Company's House, you have to make sure that you assign, say yourself as a director, anyone else that's coming in as a sort of shareholder in the business, you need to apply them shares and make them a director, a company secretary, whatever you're going to do with them in the same process.
Hmm.
Once that's all registered on Company's House, you'll get a letter through the post and all of your, what do you call it, the documentation that they send you.
Yep.
And then the next thing you really need to do is register for corporation tax for HMRC. Now, this process is sort of very similar to registering for self-assessment, as if you were doing personal tax, except you're doing this for your corporate entity rather than personally.
Yeah, so you automatically, when you register your company with Companies House, they automatically enter you into corporation tax registration. So it's not a step that you need to do separately as such. It's just it's done automatically. So you will receive a corporation tax UTR in the post.
Mhm.
So again, it's again that UTR number, but it's just for the company. Then if somebody wants to, let's say, employ people, or you are a director that wants to take out salary, what do you need to do then?
So in that scenario, once you have your UTR, because I'm pretty sure you have to use it to register for PAYE, you go through a similar process on HMRC's portal and you start register for PAYE. At
Hmm.
which point they'll send you out a PAYE reference, which you use when setting up your payroll, let's
Hmm.
say. And a few other bits that you have to do, such as making sure that you're assigned with the pensions regulator, um,
Yeah.
and a couple of other pieces that fall under that. Once you've got your PAYE reference, you can start producing a payroll for yourself, sending payslips out. It allows you to submit your real-time information to HMRC through whatever portal you have.
I would always say that Xero has a good function for just a director's salary. It has a payroll function where you can just type out your government gateway ID in there, and it's just a simple way of putting in how much you take in this month and submitting it to HMRC. It's pretty easy reporting it to a HMRC about the POE payments that you need to make, or national insurance, etc., because that's the reason why you need to register with your company with the for PAYE numbers so that you can do these reports in each month. I think a lot of the time people think, especially coming from the sole trade and a setup, thinking, oh, I'll just take money out of the company, and because I'm the director, I don't need to report it anywhere. But it's a little bit different. Well, it's a big difference. You need to tell the proverbial taxman, how you're going to take the money out of the business, whether it's salary or dividends. So we've covered on how do you register for being able to take the salary out of the business, but maybe we'll explain what the director's loan account means, because I think that people get confused with that the most, common, especially from sole trade into limited.
Yeah, so how to articulate this without drawing it on a whiteboard behind me? So your director's loan account, imagine it is sort of like imagine it's a bank account, right? And the money that goes into it is, say, money you're introducing into the business. So let's say you've put 20 grand in to invest in the business, right? That will sit as a credit on your director's loan account, right? And what makes that interesting is because it's a credit on your DLA, that means the company has a liability. It means it owes you money, okay? And until that amount hits zero, any money you take out of the business, which would go as a debit against that credit of the investment you put in, will be tax free because the company already owes you the money. It's not like it's paying you out dividends or salary or anything like that. The company just owes you the money. It's almost like an interest-free loan from yourself to your business, okay? And so the other things we start putting through your director's loan account, if you're taking a director's salary, but you're not necessarily physically paying the cash out, we'll put that against your director's loan account to build up that liability amount. Because the bigger that is, let's say at the end of the first year, you've been doing a director's salary, you've put 20 grand in and a few other bits. You've got 40 grand you can start taking out of the business personally, okay? Which means, let's say at the end of the year, you've made, £60,000 in profit. You could go, I'm going to take my 40 grand back and then maybe an additional 10. All that's going to be taxed is your additional 10 grand because the company already owed you the rest. Okay. And that's a really good way of, dodging around some of the intricacies of where you have to start telling the taxman what you're making.
Yes, exactly. So it's like a measuring account basically for the director of how much money you put into the business versus how much you take out. If you take out more than you have put into the company, there's a term called overdrawn director's loan account, and maybe we could explain what happens then.
So an overdrawn director's loan account means that if you don't issue enough dividends at the end of the year, to clear that down to zero, you will be charged on your tax return. I think it's 9% of the value. 9% of the value of the director's loan account on your tax return additionally, because you owe your company money. And the way HMRC and the government in general see this is if the company's owing you, you're owing the company a lot of money, then you're not treating it as a company should be. The company should be there to serve the company's needs, not just yours. You've got these responsibilities as a director to make sure you're doing everything you can to make sure the company is succeeding. And if you're creating a big liability for yourself, then you're just using the business as a cash cow essentially, and draining all the funds out of it without letting it be reinvested. So you have to pay this 9% on your overdrawn DLA, and you do get that money back, but only once you have cleared your director's loan account down. If you don't do that, the amount's going to keep racking up, racking up, racking up year on year, and eventually HMRC are going to come asking you about this percentage and probably saying you need to pay this back.
Yes, exactly. So when it comes to taking more than what you are owed back, so it's HMRC basically views it like a loan to you. And they say, well, basically, if you were to take out a loan anywhere else, there would be interest payable on that. So that's essentially what they are doing. So the term for that tax that you're paying is Section 455 tax. And it's a temporary tax. So it means that for the time that you have taken the loan and you haven't repaid it yet, this is the interest, the tax that you need to pay on that. Once you repay the loan, you can claim it back from HMRC. So that's why we call it the timing tax. If, let's say, the scenario is that next year you haven't repaid the loan and it's grown and it's bigger for that year. So you are paying the difference from what it was last year to this year, and you're paying the Section 455 tax only on that difference between last year and this year. So yes, ideally HMRC wants to see that you are thinking about the future of the company and you are putting the money back into the business, not just draining it from all of the sort of profits that is generated and created.
Yeah.
Because they are thinking that, okay, this company is not on going basis, it's basically trading insolvent. So we need to now look into this and actually take interest on what's going on here.
Yeah, to correct the earlier point from me, it's not 9%, it's 33.75%. So, it's a big charge that they lump on top of your corporation tax bill, should I say.
Yes,
Um,
that's grand.
yeah, and obviously this is to stop directors using the company funds as long-term personal loans.
Mhm.
Um, and like I said earlier, there can lead to additional fines and penalties from HMRC if you are leaving these out, you know.
Yeah. Yeah.
Um,
So you need to think about, okay, is my company doing well? And maybe think about how you're going to take the money out of the business. Obviously, going limited, I always advise to speak to the accountant about it and just maybe just educate about how we take money out of the business. Why does it have to be salary and dividends? And what is the tax efficient way to take money out of the business as well? Because that's another benefit of going limited, is that taking dividends out of the company is the cheapest way
mhm.
of drawing the money out of the business. It starts at 8.75%. And then depending on how much you take, obviously that grows.
But I
Uh,
think even the highest rate's still below 40%, isn't it?
it is. It
Yeah.
is still below the 40%. So obviously, from the tax point of view, if you're thinking about growing your company, and you're going to be taking healthy profits from it, I would say that going limited is most beneficial for tax reasons. Um, but yes, from registered for corporation tax and registering for PAYE, now you have knowledge about what is salary, what are dividends, how much to take, how much is going to cost you to take this out of the business. Shall we say, so there are also benefits for the limited company when you're thinking about paying into a personal pension
Hmm.
called SIP. So, what's the difference between taking it out, well, paying into a pension as a sole trader versus limited?
So obviously, if you're paying into a pension as a sole trader, you'll get your regular benefits as if you were contributing to what's known as a personal pension. Okay.
Mhm,
So by doing that, you're going to slightly increase your tax band
mhm.
based on the value you put in, but that will be coming straight out of your bank account and will likely have already been taxed as a drawing. Okay. It's classed as your profits, classed as your income, so you're getting the tax rebate, but, we're not
Yeah.
controlling where it's coming from. Okay. Whereas through a company, the company can make extra pension contributions on your behalf, which does lower the amount of tax you pay within the company.
Yes,
It comes
goes in
off.
as an expense.
Yep, it goes in as an expense, so it reduces your corporation tax bill, which is what we want. And
Mhm.
then additionally, it's going to increase on your personal tax return your basic rate band, which means that you will be paying, 20% on a lot more of the income you take rather than hitting that 40% bracket. If let's say you've put an extra £8,000 into your SIP fruit from your company, your basic rate at 20% is going to go up to £60,000 rather than 40% over
Yeah.
£52,000. And that also works with dividends. It means you're going to be paying 8.75% on your dividends
Mhm.
or a lot more money than hitting that. I think it's the 17.75% bracket at 52,000. You're hitting it at 60 or maybe 70 if you're putting more in. And then you've still
Yeah.
got that pension income coming to you 20, 30, 40 years down the line as well.
Yeah, exactly. So obviously looking at that through a limited company, it's obviously again more beneficial to do it this way because it's directly going in as a cost in your
Hmm.
business, which is a brilliant way of reducing your corporation tax bill. You can pay up to 60,000 in a year, and if that expense goes through your through your business and reducing directly corporation tax for that, that's brilliant news. And I think a lot of the people don't know that this is what can be done.
Hmm.
And actually, if you have that money in the bank and you're thinking, okay, I'm going to be taxed, heavily, I don't have anything that I need to buy in the business. I would say invest in your future, invest in your pension, think about your retirement age and what you're actually going to do with it. Because obviously, after the 55 years of our lives, we can draw it down,
Hmm.
which again, we're going to be talking about it in detail in future because pension subject is another minefield,
Yes.
I would say, and not many people understand that. Um, but yes, I think it's important to think as a director of a limited company the impacts of taking the money out of the business, what it does to your director's loan account. Is there money in the business to take out? How are you going to do this? I think this knowledge just empowers you and makes you a responsible director and shareholder.
Yeah, I think we see it a lot of the time where directors think that they can just withdraw whatever money they like from the business and it's all just going to be fine at the end of the year.
Mm.
The amount of times, because obviously for you to be able to even issue dividends, you do have to have a positive retained earnings within the company.
Yes.
And so if your company's, sort of on the brink of this or making a slight loss year on year, and you're still trying to take these dividends or just taking
Mhm.
money out, you're gonna end up with this overdrawn DLA because we'll get to a point where we can't issue dividends to, balance it out, which means you are going to have to repay money into the company. And most people, when you tell them this, they go, "But I've already spent that on my new car."
Mhm.
It's really hard to start reclaiming that money if you haven't been
Yeah.
planning it out correctly. Some people just take the money out thinking there's not going to be a tax implication, and then you go, "Look, I'm sorry, but we're going to have to put £70,000 of dividends on your account." And then the shock and horror on their faces, they go, "I've
Mhm.
got how much to pay in tax?" They're not looking at their DLA month on month and planning out, "Oh, I've taken so much here, I've taken so much there."
Mhm.
One of the big pieces of advice that I try to give to our clients is go, "Look, how much do you need to live on a month? What's the amount you want to be taking out of the business?"
Mhm.
And let's say they say to me they want to be taking, I don't know, £3,000 out of the month business a month, okay? We'll be like, okay, £1,000 of that is already covered by your director's salary, yeah?
Mhm.
So we've now just got to work out the other £2,000, okay? And let's say you're taking that £2,000 over the next 12 months, £2,000 a month, we're looking at £24,000, yeah?
Mhm.
Now, we know that's only going to be taxed at the 8.75%, which is nice and accurate.
Mhm.
Whereas if we're sort of starting to look at a lot bigger figures, you know, it starts getting a lot more messy. Because otherwise, if you're just drawing money out of the business and you get to the end of the year and you're like, oh, I've actually accidentally taken a lot more than that, you haven't planned for the
Yeah.
tax implication that's going to require.
Yes, exactly. And so this is the sort of what we do for our clients when they come over and they think, okay, I think I would like to go limited, or what we also do is we look into a sole trader accounts, obviously with the preparation of a tax return, but also early in the year, we will advise our clients whether it is beneficial for them to go limited. But before we even go towards the step of registering them as a limited company, we do have an hour's 2 hours talk about what actually limited company is
Hmm.
and how you're supposed to treat it now going forward, because it is a shock for people going from, okay, I take out, there's money in the bank, I'll take it out. It's not like that anymore. And explaining all of what we've discussed today, it just gives them the peace of mind that, okay, I know what I'm doing. It is more tax efficient for me in my scenario to go limited. But I can't just go and then dip into the bank account and sort of take it out and not tell my accountant that this is what I'm doing. As prior to us, you know, incorporating you, we explain how much is best for you to take out, but also, we look at your lifestyle. How much do you need? What can we do with that? Because it's not only just like take bare minimum and live on that. No, it's not always the ideal scenario. Some people, need to draw out much more. So we're going to be talking about the implications of tax on that. And I think this is what we do in our practice, don't we, Jordan? We just give people the knowledge and information on how this is going to be going forward.
Yeah, 100%. I think sitting down and Because I think what a lot of accountants we're finding are doing are giving them the requirements for reporting and getting all the legal stuff out of the way, but they're
Yeah.
not sitting down figuring out what our clients need from a more personal aspect, figure out how we should be setting up their financial situation or advising them on how to set up their financial situation, you know?
Yeah.
Hmm.
Yeah, exactly. Because it might be beneficial for some people to go limited, but it's just maybe it doesn't fit their lifestyle. Maybe they
Hmm.
just prefer to stay a sole trader, and that's absolutely fine as long as you have the knowledge of what it's going to do and what to expect at the end of the tax year. Because I think what we always try to avoid in our practice is to have shocked clients
Yeah.
at the end of the year. We don't want surprises. We want to be talking about this all the time,
Hmm.
communicate about, okay, if you do this, what it's going to do to your tax bill at the end of the year. And I think the most important question when taking on clients and talking about these two differences is like, what is your lifestyle? What are you expecting from this company? You
Hmm.
know, what are the future plans? How is your life? What do you need out of it? And then we are much more equipped to inform people
Yeah.
what it's going to do.
Yeah. 100%.
Okay, so this I hope that this helps and explain what the difference is between a sole trader and limited company is. But
Hmm.
obviously, would love to hear your feedback, your questions, and what you're thinking about that. Whether you explained what the difference is, and I guess the next subject we could delve in a little bit about what the dividends are as well,
Hmm.
and why sometimes you can't take it out of the business.
Hmm.
But if you join us on the next session, I'm sure there will be talking about so many interesting new things that are
Yep.
out there. And yeah, we'll see you on the next podcast.
Yeah. Brilliant.
Thanks,
See you
guys.
later, guys. Bye.